All right, guys, this is Israel. We got another mentorship session to do. I'm banging them out this week because, and if you want to know why, uh, what the markets are doing are actually inspiring me to give you the tools to understand the analysis or the points or the things that I'm throwing at you in the training group. So I want you to, for those of, especially those of you who are newer traders, I want you to understand where these things are coming from. And so the last couple of days, we've dealt with market conditions. We looked at the fact that, first of all, there's three main market conditions. There are consolidations, reversals, and trends. And that as a trader, no matter what system you have, no matter what strategy you're using, no matter how beautiful you think it is, you need to understand the context of the market conditions, because different trading concept. Trading's like a bag of tools. It's like a handyman who's got a toolbox. There's a drill for this, there's a bit for that, there's a screw for that, there's a hammer for this, there's a nail for that, there's a saw for that. You don't just take one size tool and whack away at everything, which is what many of the cowboy training programs that many of you have fallen foul to have taught you to do. They teach you a couple of strategies, half-baked. They don't show you the science behind it or the price action principles behind it. Or many times those price action principles are not sound in the first place. They give you a couple of systems, throw you a couple of signals that don't work, and then you spend years hitting your head against a brick wall. Well, this is where some of you might start to get some freedom, because when you understand the condition of the market, is it consolidating, reversing, trending on whatever your reference time frame is, not necessarily your entry time frame, but your reference time frame. I don't have time to explain, but go through the other mentorship, the previous mentorship sessions for those of you who talked about the fact that you need to have a reference time frame, an entry time frame, and a management time frame. And so you need to understand how these work. So we've looked at consolidations. I've shown you how they work, how they move the market, and how you can apply them. We've also looked at reversals. Today, I want to show you trends. But before we do that, let me revisit something from a previous mentorship a session we did, the CMRET profile. So, and how once you understand what's going on, you become a market breaker as a trader, because you're not tied to a system or strategy. You can just look at the markets and form an understanding of what's going on. And if there's a trade to be picked out, you can pick it out any way you want to pick it out. So last year I showed you guys, how if you break down any of the top three time frames, the monthly, the weekly, and the daily, you break them down. One monthly candle is a divider on a daily chart. One weekly candle is a divider on a 4-hour chart, and one daily candle is a divider on any other chart beneath that. And so if you are trading anything less than a daily time frame, you need to see what's happening on the daily time frame. That's your controlling time frame. So at a 1 hour downwards, your bias should come off the daily time frame. If you're trading a 4-hour, your bias should come off the weekly. If you're trading a daily, your bias should come off a monthly. That there will save your life. That there is gold. Believe me, that's gold right there. Now, so using that principle, I showed you guys how breaking down a 1 hour, 50-minute time frame into daily. I didn't show you the CMRET last year, but I showed you how the day usually opens up with a consolidation in the Asian session. If it's going to be a down day, it will spike out the Asian session, find support somewhere where, usually in a liquidity profile above the daily range. That's this here. That's the liquidity profile there. It's called an order block, according to a mentor of mine, Michael Huddleston. So it's found support there, and then it'll drop and run to its target, where it'll usually find support from another day's liquidity profile in the previous time frame, or in the previous session or previous day, trading. Now, let's come back here. So I just showed you that as a daily principle. Now, this year, I've started breaking it down, that this worked on all time frames, and that this is the pattern: consolidation, manipulation, expansion, retracement, target. Now, the strategy I taught you last year this would have been the entry of my trade. So I would have entered this trade here, or maybe slightly down there, just a little bit, a pip or two beneath it, just to prove to me the price is respecting that block. My risk would have been 13 pips. As of yesterday evening, it would have paid, or this morning, it would have paid me roughly 50 pips, which is above the 3-2-1 minimum payout that we go for, in this case 4-1, and I would have been happy and closed my trade. Now, I must confess to you, this trade is still open because I forgot it last night. I was so busy with other things. And this is the beauty of good risk management. Because this trade, for me, the risk in this trade is 0.5% of this current account. So this trade right now, if I'd lost it, I would have lost $50, which is 0.5% roughly. This account is currently just under 10 grand. And so it didn't mean much. And this is the beauty of risk management. You can make decisions based on principles, not emotions, not, oh, my life savings are disappearing. So, but I forgot it in. And because I would have closed there yesterday, I'll have ignored this whole retracement today. And then picked up the trade from this high point today, and I'll have been in profit again. But it's all right. I forgot to do that. I was busy. I have a life. I have a wife, children, other pursuits, other businesses. So it went through the retracement. Now, I'm in two minds as to whether or not to close it, because we're approaching a liquidity profile just below. This might be a safe place to take my profit and disappear, but because it's 0.5%, there's a weekly gap. Let me see if I can find that and show you. There's a weekly gap in the there we go. So there's a weekly gap in the EU that I'm expecting price to eventually close, which is why my take profit is down there just above the gap. And so 0.5%, even if I lose it, doesn't mean anything to me. I want to just see if that's correct. If it is, I can brag about it on the mentorship group and say, hey, close the gap, and I took the trade. If it doesn't, hey, life goes on. 0.5% is not going to change my life, and it shouldn't change yours, which is why I teach you to trade the way that I teach you to trade. So coming back to this here. So for the sake of argument, I want you just to ignore what happened past that point there. Because like I said, ideally, in an ideal world, I would be out of this trade by now. So just ignore that on your chart, right? Let's just deal with this. So here we go. Trading. Oh, this keeps snapping back. Okay, yeah, I know why. So let's try this now. So let's ignore that. Yeah, past that point, just ignore that. So trading involves, like I said, if you understand how price moves, you become a market breaker, meaning you're not tied into one or two boxes. You can flow with the markets, and it's beautiful being able to flow with the markets. Now, the strategy I taught you last year, I didn't explain to you that it was a trending strategy, because I'm showing you this with the trending market condition, because this is an example of this in motion. Just one quick second. All right, cool. So, showing you this now with the trending profile, because or trending condition, because this particular style of trading works with the trending condition. Now, I have established that based on the 4-hour, I am in a trend. I'm going to show you that in a second. Don't worry when I do with the actual teaching. But look at this. This is obviously a trend, right? There you go. So you would agree with me that from here, from this point down to this point here, we're in a downward trend, a bearish trend on the 4-hour chart. You could argue as well that it's the same on the daily chart, but I'm just going off the 4-hour here. And as a result of this, when I'm dipping down from a 4-hour into a lower chart, which would at least be a 30 minutes, because you dip down in steps of 2 or more downwards. I'm only looking for bearish trades. So I'm using the 4-hour as my directional bias in this principle here. The daily also confirms that, because there's a daily engulfing at the top here. On the 15-minute chart, all I'm interested in is shorts. Are there bullish trades to be taken and won in that period? Oh yeah. But what? Let me show you this, for instance. Why would you want to take 23 pips when in the same day, just by being patient, you could take 60? I'm really just asking. I just want to know. Are you that desperate for a trade? Now, if your system involves trading short-term reversals on a scalping basis, fine. That means your system or your strategy, your pro, that's good. But if you're just flowing with the market, why take a third in one direction running against the tide of what you could take in the other direction swimming with the tide? So if you understand that we're going downwards, every day you wake up in the market till the market reverses, just wait for the CMRET to pan out downwards. Now, this is a daily chart, it's a day trade. This would work with an intra-week or whatever. So this is how it goes. Price opens with a consolidation in Asia because it is a Euro American pair. In essence, there is no Asian currency in this pair. So we don't expect any significant sponsored moves in Asia, because the people, the market makers who are going to be sponsoring those moves are asleep. They're asleep in the UK, and they're off work in Europe, and they're off work in America at least, and then asleep for part of it. And so the day opens when the European traders open. We expect in the short, so when we see the market running long, we're happy. It tells us where this is going to be a good day for us. It's not one of those Z days that fakes you out both ways. Well, it could be, but at this point, it's not. Find support there at the time you would expect it to in London Open, 9 a.m. So at the end of London Open, but still, it's a valid trade. I was busy. I wasn't looking at my charts. I should have, but I wasn't. It was a very busy day for me. In fact, I think I was asleep at 9 because I had a very long night. And so I missed this opportunity to enter. Now, if I wasn't a market breaker, if I was a system follower, I would have either lost out on that trade altogether, or I would have chased it by entry, because when I did wake up, price was here. I woke up when I got to my chart, it was about noon. That's about 2 o'clock on the server, because the server is about 2-3 hours ahead of me. Depends on what time of the year it is. Now, can you imagine trying to get in here and putting your stop loss there? Or here, to be precise. That is baloney. That's what some of you do, because you just have to have the trade. So first chance will be walk away. But if you must trade, because I wanted this trade to teach this to you guys. If we're doing CME, so consolidation, manipulation, expansion, and retracement, where did I teach you to look for the retracement? The halfway point of the consolidation zone, plus a few pips to look after a spread. So look at this. That's the halfway point of the zone. How many pips is that? That's 1.8 pips. I put my entry at 3 pips beneath it to be on the safe side, because there's nothing more annoying than missing out on a great trade because you were trying to be too cute. And so it comes back as I expected to on the retracement. And all I did was put my stop loss 1 pip above the consolidation. Now, are there times where it breaks through the consolidation and then goes all the way back up here? Yes. that is very possible. It could still, I'm still in the trade because I want to test to see if it gets all the way to the weekly gap. It could still do that, but we're playing the averages here. If you take this setup 5 times, it will not break that consolidation more than 2 or 3 maximum. And I showed you in one of the mentorship sessions that even if you're batting 2 out of 5 with good risk management, if you're taking 1% or less, in this case, 0.5% on your losses, and you're doing 3-1, even if you bat 2 out of 5, you will still make plenty of money. 2 times 3, 6. 3 times 1 is 3. So if you bat 2 out of 5 on a 3-1 risk to reward ratio, you're going to make you're going to be up 3% or 3 times however much your risk is after every 5 trades. You will not have 5 trades where in more than 3 of them, in this scenario, the price violates this Asian range again and still pays you. Usually if it violates the Asian range again, that means you were wrong for the day. It's going the other way. In which case, why just not cut your loss there? Why wait for more of a loss up there? And so that was my entry yesterday. And this is the beauty of understanding the markets. You don't have to stay at them. I forgot about this trade. If I'd been awake, I would have closed it here. That's the truth. Because at this point, I would have had, let's see, my entry here. So that's exactly 10 pips was my stop loss. As at here, I would have had 33 pips as at this morning doing so basically this is going to be 4-1. And usually I usually am out of 4-1. I usually set my stop loss for 4-1 because I like to do 4, not 3. I put it at the weekly gap to test it out. But if I'd looked at this when I woke up this morning after Asia and I saw this moving, I would have closed it around here for 3-1 because I would have expected a retracement. What retracement would I have expected? A Fibonacci retracement from this being the original retracement to the middle of the consolidation, all the way down there. And so I would have expected price to get at least back to the 61 and usually halfway between 61 and 17.6. So I would have set another entry for here. I'll have had a little bit of drawdown. That would have been my new stop loss would have been there, back to that high there. That would have been 12 pips. And right now I would be 18 pips up. So I'd be more than 1% or more than 1-1 up, but I would already have banked at least 3%. But hey, I missed it. It happens. I'm not sweating it. Like I said, this trade for me wasn't so much about the money. I want to just see if price does get to the weekly gap. I'm working on some psychological development milestones for myself, and I want to see how to, anyway, that's just me. I'm doing some personal development, and that's what this trade is for. So if it loses 0.5%, doesn't do me too much damage. So that's just how it works. You could have gotten here. You could have gotten in here. If you missed it yesterday, you would have gotten in here today because you understand the framework of what's going on. You're a market breaker. You're not a cowboy chaser. You're not a trend line fanatic. And so, welcome to Trading the Right Way. This is Israel. See you guys. Now I'm going to record the real mentorship session. Take care, guys. Bye-bye.